Once upon a time, not so long ago, the most efficient way to get a lot of people to do a lot of work for very little reward was through a system that was, to put it mildly, morally reprehensible: slavery. It was a system of direct, physical control. You owned a person, you made them work, and you reaped the benefits. It was brutal, it was obvious, and eventually, civilized societies agreed it was an abomination that had to be abolished. But the desire for a large, compliant workforce that could generate immense wealth for a select few didn't just vanish into thin air. It simply got a rebrand. It evolved into something far more subtle, more sophisticated, and arguably more effective, because the chains are no longer made of iron, they're made of numbers on a screen. Imagine a clever landowner who, instead of using whips and chains, decides to use a ledger. He frees his workers but tells them they now owe him for their food, their shelter, and the very land they stand on. He pays them in a special currency that only he issues, and then charges them interest on their debts. Suddenly, the workers are free, but they are also trapped. They must work for him to earn the very tokens they need to pay him back, plus a little extra that he just made up. This is the fundamental, almost comically sinister genius of the system we live in today. We transitioned from a model of physical ownership to one of economic obligation. A system where debt ensures compliance just as effectively as any overseer ever could. This new system is far more elegant. You don't have to house or feed your workforce directly. They have to figure that out for themselves. They take on the responsibility for their own survival, all while being locked into a cycle of earning to pay off debts that are designed to grow forever. It's a psychological masterpiece of control. People believe they are free because they can choose their job, their house, their car. But the underlying mechanism is that they must borrow from the modern landowners, the banks, to acquire any of it. And so, the vast majority of the population willingly, even eagerly, walks onto the plantation, signs the contract, and spends a lifetime working to pay off an ever-compounding debt. The beauty of this model, from the perspective of those at the top, is its scalability and its invisibility. You can enslave an entire population without them even realizing they've been captured. They don't see bars on the windows, they see mortgages, student loans, and credit card statements. They are driven not by the fear of physical punishment, but by the quiet, gnawing anxiety of a negative bank balance and a bad credit score. This is the quiet revolution that replaced one form of servitude with another, swapping out the blatant cruelty of the past for the quiet desperation of modern economic life. It's a system that has been perfected over centuries, and it governs almost every aspect of our world. So, where does all this money we borrow actually come from? If you're like most people, you probably picture a government mint somewhere, with giant machines stamping out crisp dollar bills and shiny coins, which are then delivered to banks. That's a lovely, quaint image. It's also almost entirely wrong. The reality is far more bizarre and, frankly, a little disturbing. The vast majority of the money in our economy, we're talking over 97% of it, is not created by the government or the central bank. It is created out of thin air by private commercial banks every single time they issue a loan. Yes, you read that right. When you go to a bank for a mortgage, the bank doesn't lend you money it already has. It just types the numbers into your account. Poof. New money. This process is called fractional reserve banking, but even that name is misleading because in many countries, the fraction they need to hold in reserve is now effectively zero. Think about it. You ask for a $300,000 loan to buy a house. The bank checks your credit, says yes, and simply credits your account with $300,000. At that exact moment, the money supply in the economy increases by that amount. It's not a transfer, it's a creation. The bank literally invents the money, and in return, you promise to spend the next 30 years of your life working to pay it back, with interest. The bank risked virtually nothing. It didn't have to give up any of its existing assets, yet it gets to collect a massive stream of real payments from your real labor. The small sliver of money that the government does create, the physical cash in your pocket, and the digital reserves held by banks, is known as the monetary base. But this is just the tip of the iceberg. The real action happens in the private banking sector. They have been given a state-sanctioned power that kings and emperors of old would have killed for, the ability to create money from nothing. This privatized money creation system is the engine of our entire economy. It determines who gets money, what it can be used for, and how much it costs. And because banks are for-profit businesses, they tend to create money for activities that are profitable for them, not necessarily for what is good for society, like, say, speculative real estate bubbles instead of renewable energy projects. This is the central, mind-bending truth you must understand to grasp everything else that's wrong with our economic system. Most of our money is debt. It is brought into existence as a loan. It exists as a number on a ledger, and it disappears when the loan is repaid. The entire system is a giant privately owned revolving door of debt creation. The government has effectively outsourced the creation of its own money supply to the very institutions that crashed the global economy in 2008. And they did it so quietly that most of us are still under the illusion that money is a public good, carefully managed by our elected officials. It is not. It is a private product, sold for profit. So, we've established that banks create money out of thin air. But what is this money they're creating? What gives it value? In the old days, money was often a physical commodity. It was a gold coin, a silver piece, or even a seashell. It had intrinsic value because it was a tangible object that people agreed was rare and desirable. You could melt down a gold coin and you'd still have a lump of valuable gold. Today, our money is what's known as fiat currency. The word fiat comes from Latin, meaning let it be done. Our money has value simply because the government declares that it does, and because we all collectively agree to accept it as a medium of exchange. It's backed by nothing but faith. This isn't necessarily a bad thing in itself. A system based on trust can be very efficient. The problem is what our fiat currency actually represents. When a bank creates $300,000 for your mortgage, that digital money isn't an asset in the way a gold coin was. It's a liability. It's a token representing a debt that you owe to the bank. Think of it this way. Our entire money supply is essentially a collection of IOUs. It has no direct claim on any real physical asset. It's just a placeholder for a promise to pay. This makes our currency fundamentally different from actual wealth. Actual wealth is the house you live in, the food you eat, the skills you possess. Our money is just the abstract scoring system we use to trade that wealth. This distinction is crucial. People spend their lives chasing money, believing that accumulating it is the same as accumulating wealth. But it isn't. Money's value is not stable. It can be created in infinite quantities by banks, and its purchasing power can be eroded by inflation. Real assets, on the other hand, have tangible utility. You can't live inside your bank account, and you can't eat a stock certificate. The system encourages us to confuse the symbol, money, with the substance, real wealth. We work for money, save money, and worry about money, forgetting that it's just a tool, a very flawed and manipulated tool, for accessing the things we actually need and want in life. The entire global financial system is built upon this collective belief in the value of these debt-based tokens. We all agree to pretend that these numbers typed into a computer are worth something. It's like a global version of the story, The Emperor's New Clothes. The bankers, like the swindling weavers, have created a magnificent currency that everyone praises, yet it has no substance. It functions only as long as no one points out that the emperor is, in fact, naked. As long as we all keep believing and keep taking on more debt to create more of this fiat money, the system stumbles along. But its foundation is nothing more than confidence, and as history has shown us time and time again, confidence can be a very fragile thing. To understand why this debt-based system is inherently unstable, let's use a simple analogy: a game of musical chairs. Imagine 10 people are invited to play. The host, a friendly neighborhood banker, provides 9 chairs. To get a seat, each person must borrow $10 from the banker. So now, there are 10 people, each with a $10 loan, for a total of $100 in debt in the game. The banker then starts the music, and everyone has a grand old time dancing around, passing the money between themselves, buying and selling little trinkets. The economy of the game is humming along, but here's the problem. When the music stops, there are only 9 chairs. No matter how skilled or hardworking the players are, it is a mathematical certainty that one person will be left without a chair. There is no scenario in which all 10 players can win. The game is designed from the outset to produce a loser. This is precisely how our economic system works. There are always more debts owed than there is money in circulation to pay those debts. The players in our economy, individuals, small businesses, even entire countries, are all scrambling to find a chair by earning enough money to service their loans. But because of the structure of the system itself, someone, somewhere, must default. It's not a possibility. It's a built-in feature. This built-in scarcity creates a state of perpetual systemic competition. We are not just competing for jobs or resources. We are fundamentally competing for the very money we need to avoid bankruptcy. This pressure forces everyone to act in certain ways. It encourages short-term thinking, risk-taking, and often a dog-eat-dog mentality. If you don't keep running on the hamster wheel, you risk being the one left standing when the music stops. This explains the constant underlying anxiety that permeates our society. The fear of foreclosure, of bankruptcy, of being unable to pay your bills. This is the emotional fuel that keeps the whole machine running. It's the modern equivalent of the overseer's whip. The most insidious part of this game is that the banker, who set up the impossible rules, faces no risk. When a player inevitably fails and defaults on their $10 loan, the banker doesn't just lose out. They get to repossess whatever asset the player pledged as collateral: their tiny house, their little car, their dignity. The banker gets the chair back, ready for the next round of the game, and can even collect the defaulted debt from the loser's future earnings. The system is perfectly designed to ensure that a steady stream of failures occurs, which allows those who control the money supply to systematically consolidate real assets from those who are forced to borrow from them. It's a game you can't win, but you're forced to play. Now let's dig into the mechanics of why the musical chairs game is, honestly, impossible to win. The core of the problem lies in a single, simple concept: interest. When a bank creates a loan, say that $300,000 for your mortgage, it creates the principal amount. The $300,000 is typed into existence. But what the bank does not create is the money needed to pay the interest on that loan. Over 30 years, you might end up paying back over $600,000 in total. The bank created the initial $300,000, but where is the other $300,000 for the interest supposed to come from? It doesn't exist. Not yet, anyway. This is the critical flaw, the mathematical black hole at the center of our financial universe. The only way for new money to come into existence to pay the interest on past debts is for someone else to take out a new loan. For you to be able to pay back your loan plus interest, your neighbor, or a local business, or the government must go deeper into debt, creating the extra money that you can then earn. This means that for the system as a whole, the total amount of debt must always be growing. It is mathematically impossible for all debts to be repaid. If everyone tried to pay off their loans at once, we would find that there simply isn't enough money in existence to cover both the principal and the interest. This creates a systemic imperative for endless growth. The economy must constantly expand, not necessarily to create more well-being or happiness, but simply to generate enough new debt to service the old debt. It's like a shark that must keep swimming to breathe. If lending slows down, the supply of new money dries up. Suddenly, there isn't enough to go around to pay all the outstanding interest payments. Defaults begin to cascade through the system, businesses fail, people lose their jobs and homes, and the entire house of cards comes crashing down. This is what we call a recession or a depression. It's not an accident. It's a predictable outcome of a system that requires exponential growth forever on a finite planet. So, when you are working hard to pay off your mortgage, you are not just working for yourself. You are competing with everyone else to capture a piece of a money supply that is deliberately kept insufficient to pay off all outstanding debts. The interest you pay is not just profit for the bank. It is the driving force that ensures there is always more debt in the system than there is money. This is the debt trap. It guarantees that we, as a society, can never be free of debt. We can only shift it around, refinance it, and push the day of reckoning further into the future by borrowing even more. It is a cycle of ever-increasing indebtedness by design. To prevent the inevitable collapse caused by the interest trap, the system has a solution: more debt. The entire financial industry is built around keeping the debt machine churning. When people and businesses can't pay their old loans, the solution is not to forgive the debt, but to offer new loans to pay off the old ones. This is called refinancing. You roll your old, unpayable debt into a new, bigger loan, often with new fees and a longer repayment schedule. This kicks the can down the road, keeps the borrower on the hook, and allows the bank to continue collecting interest. the principal debt never actually gets paid down. It just gets larger and more unmanageable over time. This constant need for new lending has created a vast and complex global market where debt itself is the product. Mortgages, car loans, student loans, and credit card debts are bundled together into complex financial instruments called asset-backed securities and sold to investors around the world. These investors, pension funds, insurance companies, and other banks, are all desperate for a steady return. And these debt bundles promise a reliable stream of interest payments from millions of ordinary people. Your monthly mortgage payment is no longer just going to your local bank. It's been sliced and diced and sold to a hedge fund in Singapore or a pension plan in Germany. The system has become an abstract game for financiers, completely disconnected from the real lives it impacts. This creates enormous pressure on everyone to borrow more. Governments are pressured to run deficits to stimulate the economy, that is, to enable more private debt creation. Corporations are pressured to borrow for stock buybacks to boost share prices, and individuals are bombarded with advertising from cradle to grave, encouraging them to borrow for a better car, a bigger house, a more expensive education, or even just a vacation. You deserve it, the ads say. What they mean is, the system requires your indebtedness to survive. A person who lives debt-free is, in a way, a threat to the system. They are not contributing to the creation of new money and the payment of interest that the machine needs to keep running. The result is a society running on a treadmill of debt. We have to run faster and faster, work harder, take on more jobs, borrow more, just to stay in the same place, just to keep our homes and feed our families. The goal is no longer to get off the treadmill by becoming debt-free. The goal is simply to keep up with the payments so you don't get thrown off. This relentless pressure creates immense stress and anxiety, contributing to a host of social and health problems. We are constantly chasing a future prosperity that is made ever more distant by the very debts we take on to reach it. It is a cycle of perpetual motion that enriches the lenders while exhausting the borrowers. Your grandparents were right. A dollar really did used to be worth a lot more. They weren't just being nostalgic when they talked about buying a loaf of bread for a nickel or a new car for a couple of $1,000s. This steady, relentless decline in the purchasing power of our money is a direct consequence of our debt-based system. It's a feature, not a bug, and it has a name: inflation. When banks are constantly creating vast sums of new money as debt, they are increasing the overall supply of money in the economy. And just like with anything else, when the supply goes up, the value of each individual unit goes down. Your dollar buys less than it did yesterday. Since the creation of the Federal Reserve in the United States in 1913, a pivotal moment that solidified the power of private banks over the money supply, the US dollar has lost over 96% of its purchasing power. Let that sink in. What you could buy with $1 in 1913 would cost you over $30 today, in 2026. This isn't an accident. Central banks around the world now openly target a healthy inflation rate of around 2% per year. This means they are actively trying to devalue your savings by 2% every single year. Why would they do this? Because in a debt-based system, inflation is a necessary evil. It makes it easier for borrowers to pay back their loans with cheaper, less valuable money in the future. Inflation is a hidden tax that disproportionately punishes the poor and the prudent. If you are a saver, putting your money in a bank account that earns 1% interest while inflation is running at 3%, you are losing 2% of your wealth every year. Your money is literally melting away. On the other hand, if you are heavily in debt, inflation is your friend. It erodes the real value of your debt over time. The system, therefore, punishes savers and rewards debtors, pushing everyone further towards the act of borrowing. It is a powerful, silent force that transfers wealth from the working class and retirees to the government and the banking sector, who are the biggest debtors of all. This constant devaluation of currency is why people are forced into riskier investments like the stock market. You can't simply save your money anymore. You have to put your money to work to try and earn a return that outpaces inflation. This benefits Wall Street and the financial industry, which profits from all this churning and trading. The average person is left with a terrible choice. Either watch your savings evaporate slowly in a bank account, or risk losing it all quickly in a volatile market you don't understand. The safe, sensible path of simply saving what you earn has been systematically eliminated. So what happens when this delicate, over-leveraged system breaks down? What happens when the lending stops and the music finally stops playing? We saw exactly what happens in 2008. The crisis began when the supply of new borrowers for subprime mortgages dried up. Without new loans creating new money, people could no longer afford to make payments on their existing loans. Defaults skyrocketed. The complex debt securities that had been sold to investors all over the world were suddenly revealed to be worthless junk. Confidence evaporated overnight. Banks stopped lending to each other, credit froze, and the entire global financial system went into cardiac arrest. This is what's known as a credit crunch or a debt crisis. When the creation of new debt money slows or reverses, the system contracts violently. Businesses that rely on credit to manage their cash flow suddenly can't make payroll. They lay off workers. Those workers, now unemployed, can't pay their mortgages or credit card bills. Demand for goods and services plummets, leading to more business failures and more layoffs. It's a vicious downward spiral. The system that requires endless growth to function suddenly goes into reverse, destroying jobs, savings, and lives in its wake. And who pays the price? Not the bankers who caused the crisis. They got bailed out with trillions of dollars of, yep, you guessed it, more debt created by central banks. The effects are even more devastating for developing nations. These countries are often lured into debt traps by institutions like the World Bank and the IMF. They are encouraged to take out huge loans, denominated in foreign currencies like the US dollar, to fund large infrastructure projects. But when a global crisis hits, or when their own currency weakens, the real burden of that foreign-denominated debt explodes. They are forced to slash spending on public services like healthcare and education to make their interest payments. They are often coerced into privatizing their public assets, water systems, power grids, natural resources, and selling them off to foreign corporations at bargain basement prices. It is a brutal form of modern-day colonialism, enforced not with armies, but with spreadsheets. The 2008 crisis was not a freak accident. It was a predictable, inevitable outcome of a system with the flaws we've discussed. And because we never fixed the underlying problems, we just papered them over with more debt, we are destined to repeat it. The total amount of global debt is now significantly higher than it was before the 2008 crash. The game of musical chairs continues, but the stakes are higher, the players are more desperate, and the music is getting dangerously close to stopping once again. The question is not if another crisis will happen, but when. So, we're all trapped in a giant, unstable, privately owned debt casino. Fantastic. Is there a way out? Or are we doomed to an endless cycle of booms, busts, and bailouts? The good news is, there are solutions. The bad news is, they require a fundamental rethinking of the very nature of money and power. The first and most important step is to end the bizarre privilege that private banks have to create our money supply out of thin air. Money should be a public utility, not a private commodity. This is an idea known as sovereign money or public money. The state, and only the state, should have the power to create money, debt-free. Imagine a system where the government, accountable to the people, creates the money needed for the economy to function. It could spend this new money directly into the real economy, building infrastructure, funding green energy, paying for healthcare and education, or even distributing it as a citizen's dividend. This money would be an asset, not a debt. It would circulate permanently, without the need for a corresponding private loan. Banks could still exist, but they would have to act as true intermediaries, lending out money they actually have, not money they invent. This would strip them of their godlike power and turn them back into the boring, useful service providers they ought to be. Furthermore, we need to encourage monetary diversity. Why should we all be forced to use a single, centrally controlled, debt-based currency? Communities could be empowered to create their own local currencies to facilitate local trade, strengthening their economies and making them more resilient to global financial shocks. These currencies could be based on anything the community deems valuable: an hour of labor, a bushel of wheat, or a kilowatt-hour of energy. This would break the monopoly of the bankers and return power to the people, allowing them to decide for themselves what has value and how it should be exchanged. It's about monetary democracy. Of course, the most powerful tool for change is knowledge. The current system survives largely because it is misunderstood. It is deliberately shrouded in complex jargon to prevent ordinary people from grasping its essential and frankly absurd nature. Spreading awareness is the first act of rebellion. Understanding how money is created, who profits from it, and how it drives inequality and instability is the key to building the political will for fundamental reform. We need to have a global conversation, not about how to tweak interest rates, but about what money actually is and what we want it to do for us. The path to a sane and stable economic system is not through more regulation or bigger bailouts. It is through a complete and total transformation of the system itself. We must reclaim the power to create money from the private banks that have abused it for so long. We need to design a system that serves humanity, not a system that forces humanity to serve debt. This is not a utopian fantasy. It is a practical and necessary step towards creating a just and sustainable future. The current system is a ticking time bomb. It's time we got to work defusing it, and the first step is to simply open our eyes and understand the game we've all been forced to play.